Hi, this is Kim Watson. Welcome to this week's Big Picture. If you're not familiar with the Big Picture, basically it's a video I do once a week generally. I've missed August out, but normally because of the holidays and the quietness. However, it's been there's been some good volatility through August. But as we approach September, I think it's very important to bring ourselves up to date with what's what really. So what am I looking at? I'm looking at economic strength here. And I grade each of the major currencies from 1 to 7 effectively for economic strength and where they sit here. I then look at what's the big money doing. So what's the asset managers in particular, what are they doing with their money, where are they going with their money? I've done plenty of research on COT sentiment, the commitment of traders sentiment, and generally these guys, they tend to be forward thinking, they tend to move slightly earlier, sometimes too early, but they're more likely to be early than late, and they give a good guide in the and this is the big picture video, and they give a good guide for the big picture in terms of where the money's likely to be moving. Now you can find out more about COT sentiment if you just search our videos and just put COT report in there, and it will come up with what I'm looking at from that. But what I'm looking at, I'm grading them. I'll show you some more detail of this in a moment, but I just grade them from 1 to 7 in terms of the strength from looking at what particularly the asset fund managers are doing. Then I'm looking at the change over the 3 months, and this is just purely in terms of change technically from where the price was of that currency 3 months ago to where it is now, and looking at the strongest and weakest. So this is really a bit of an overall guide to what is the strongest, what is the weakest. Now, badly drawn square there. So then I put the whole lot together and I grade the currencies from 1 to 7 overall, and basically it's the tally of the numbers that sit here grades them, and I put them in fact in joint 6th place at the moment. We've got the New Zealand dollar and the pound. The New Zealand just dropped it back, dropped back a bit more, went a bit softer than the Aussie dollar, so he switched the handle there. But basically what use is this? Well, it is a big picture. It's looking at not intraday moves here. We're looking at what the trends may be and are, in a sense. This will probably be more relevant to what the trend is. This is looking at this upper deck, if you like, is looking at how things are turning out. So we can see weakness starting to apply in markets quite early. So we'll see the GDP figures falling, etc. Manufacturing production numbers starting to fall, employment move maybe. We can see that as an earlier stage. There's some early signals that we'll see that, and that will start having an effect up here. But the big money is keeping an eye on things for us anyway, so we can really just look at often what they're doing. And it'll give us a guide. It won't give us a guide on an intraday point of view, but more on the position point of view they certainly will do, which could affect our overall view of those markets. The other thing, of course, is if you've got something that's labelled as the strongest here and the weakest here, you can be crossing over and looking at maybe trading some of these stronger markets against some of these sort of positioned 5th, 6th, 7th. You may find some more decent volatility and some nice moves. I mean, we often see good moves in the pound yen, for example, anyway, but when things are in particular, one's particularly weak and the other one's strong, it gives us better opportunity to trade in that direction. Okay, so what else am I looking at here? Let me just get rid of the pens here, so I'll put 2 pens on at the moment. Then the detail behind this is split into 3 boxes once again. I'm really looking at what the central banks are, how they're reacting to what I'm seeing there in terms of fundamental weakness or strength. So we're seeing them adjust interest rates and do whatever they can do to stimulate the economy. From that point of view, you've also got these guys, these asset managers. Some of them will be a step ahead in a sense. They're doing their own analysis. They've got their own teams of economists or whatever else trying to catch an edge in terms of what may happen. So if we're looking in terms of going to have to redo that. Let's just go back on that square again there, see if we can do that. So we're looking really, there we go. So we're looking at this area here. This will, particularly the asset managers, which hold much bigger positions in general. We can see what they're doing, what their trends are doing, and look at particularly where they go from a bullish to bearish stance on an asset. On a currency, it can often just be a confirmation. I mean, by the time they've gone bullish to bearish, big time, you'll have seen a trend build there. So that sort of starts confirming even more of a trend quite often. So it's a bit of a slow movement. But what they also do show us with the combination of both asset and hedge managers' money is we get extremes in the market sometimes. We had it back when the New Zealand dollar late last August, I think it was August, September time, it got into an extreme position with short positions. Not happening this time, I would add, but that extreme can sometimes show us where there's no one else to be short. It may get a bit of a bounce here, and sure enough the New Zealand dollar got a decent bounce in the months following that, and these both the asset managers, hedge managers, changed for a while, but they are bearish again at the moment. So that's the overall view of the, as I say, this is the commitment traders, the big money, what they're doing. If we follow the big money, then they're going to be more right than a lot of the retail traders, for example, who are mostly wrong. Okay, and the other important thing on this chart here, what's coming out this week. So I'm going to run through this now. And sorry, I should say also I'm looking at the trend on the far right hand side here in terms of how the trends are actually running on a weekly and daily basis. So as I say, it's just a big picture overview here. So US dollar. We've got no increased rates, no rates increases. We've got no meetings to discuss until 2 or 3 weeks time, so it's due in September, and it's expected that we'll see a further cut in September and October. They're pretty much priced in with a high percentage. There's a 30% chance now, it's reduced actually, cut in December, so there's expected at least 2 more cuts there, so we'd expect that to drop to 1.75. Now the asset managers, you'd expect they'll be obviously dropping that down, but one thing I would say here on the COT sentiment, they hold very few, a modest amount of positions in the US dollar effectively. They're generally going short on the euro, the pound, or whatever it is, the weakest currency or the strongest currency they're going long on, so they're generally playing it in that direction as opposed to playing the US dollar as a whole. So the US dollar doesn't have so many positions sitting there, so it's more important looking at what the euro's doing, the pound's doing, the yen, and etc. But anyway, there's an element of bullishness sitting around that anyway, regardless of what's expected to be cut, because money's expected to run into the US dollar in this particular occasion. The trade wars are certainly fueling this. The more pessimistic, and if we see data and the data falling over here, money comes out of assets, and we're seeing that, certainly seen that in the movement of the asset managers holdings on the S&Ps here. This is the S&P 500. We're seeing from 940 positions long, net 940 even, it's dropped down to 700 contracts long, so it's quite a significant change over the last couple of months, or last month or so. Anyway, coming back to the dollar, what I'm suggesting here, from the weakness of equity, etc., it forces money into US dollar, and we're seeing weekly and daily trends. In fact, we're seeing 2-year highs kicking in here on the US dollar, so it's certainly pushing the strength up there, and that's hence why the reason we're seeing the hedge and the asset money going back in there, or pushing back up there, I should say. So key numbers to watch out for this week: manufacturing services, 3rd and 5th respectively, the non-farms on the 5th and 6th, and because it's the ADP figure so close to Friday, I don't think we'll see too much excitement around the 5th. It'll be all sitting around the 6th. We've got speakers, Fed speakers on the 3rd, 4th and 6th. The most important one of those is the Fed chair, Powell, speaking on the 6th in Switzerland, talking about the central bank's role. But I think there may be a bit of some clues in there still, so well worth watching out for. But it'll be a bit late in our day trading day there. But watch out overall as a bigger picture. Euro stinks in a lot of ways. It's I don't mean it's rude. I mean what I mean is the currency stinks. The economic strength of the economy is overall economies. We're seeing Germany running into almost recession, if not confirmed yet, but it's certainly seen big drops. The manufacturing data has been falling into contraction, so we're seeing this running through. In fact, France is outdoing Germany in the numbers there at the moment, but Germany is the powerhouse of the European zone, and if that's starting to fall, we could see further weakness for the euro effectively. They're not meeting for a couple of weeks, but there's a suggestion there's some complex options being considered, along with asset purchases and the central bank from the central bank point of view. So we'll see what happens there. Realistically, I think it's up to the likes of Germany, etc., to actually start pumping money and actually spending on the economies internally, but they're so dependent, likes of Germany, dependent on export, that times like this, when we get trade wars, etc., running in, it kills, and they're getting hurt at the moment from that. I've put no economic news, no significant economic news affecting or regarding the eurozone as such, but of course the US data will affect the euro-US dollar. So be wary, looking at the moment trend-wise, weekly and daily to the downside. The pound Brexit is keeping the things alive there. One thing to watch out for is asset managers. This may change again, but at the moment they've flattened out here in terms of their net bearish positions here. And I do wonder if they're waiting to see if something may come from the current conversations, meetings, etc., in Europe between Johnson's team, etc. We'll have to have a look. But key this week: services PMI, inflation report hearings. Otherwise, at the moment, the risk is really to the downside for the pound. So that remains bearish for me. And we've got weekly trend and daily trend still pointing south. Yen can be seen as a safety currency, and just watch out for that. It could strengthen against the US dollar even, but it could strengthen more significantly against some of the other pairings as well. Just watch for it. Asset money dropped off a little bit. It's still bullish though. Hedge money just slightly a bit more bullish. No economic news this week, so quite weak in terms of the yen, but obviously affected by the trade wars, as most of these countries, or all countries are. But watch out for money running into safety there. Aussie dollar is pressure now. We've got the Aussie dollar and the Canadian dollar. Both central banks are meeting this week. There's certainly pressure on potential cuts for the Aussie dollar, but they've got less to give away. But there's expected 2 more cuts expected by March. Whether that will happen, we'll see. It's not saying expected, not this time though. So sitting there at 1%, and it's expected to stay now. Any surprise from that, we'll see the Aussie sell quite quickly. They're struggling a little bit, and you see the money coming out here, or the bearishness that's sitting around the Aussie dollar from the asset money. Some of this, and I say some of this, the overall picture, and as I said, it goes back to the big picture and the economy, and the ore sales and prices are low. They're really tied up with the likes of China in terms of on the supply side, and these trade wars are just knocking and having their backing up and affecting currencies, well, a lot of countries in terms of the supply side. So the Aussie dollar particularly hit there, and it looks weak monthly, weekly and daily and monthly. Canadian dollar again, well, there's lots of talk in the press of a cut done early. Fundamentally, they're not doing too bad at all. In fact, some of the numbers and the GDP, etc., is above in front of expectation. Numbers are kicking out okay, but there is pressure all the same to cut rates, because it could backfire these higher rates here. But they do tend to move slowly, but there's only a 17% chance at this week's meeting of a cut. However, watch out for the wording. It's anything that gets particularly dovish there that we will cut rates or will do things to stimulate the economy. These will be taken as a as a cut now effectively, and we'll see the Canadian dollar sold, to watch for that. Otherwise, we've got the employment data coming out on Friday, which has been holding up pretty well of late overall. Asset and hedge money slipped off a little bit there in terms of the long positions, net positions down, but still long. But technically, weekly, we're still in that downward trend for the US dollar versus the CAD, remember, so it's inverted in some respects if you get your brain around this. The Canadian dollar's effectively been getting weaker as we've seen the US dollar get stronger on a daily basis, but yet to change the big picture of the slightly weaker US dollar against the CAD. So the CAD's holding up quite well, but that may all change come Wednesday. New Zealand dollar, interest rate cut down to 1% as a surprise cut in August. No economic news this week. It just remains weak in my book. It's negative on the from the weekly and daily basis. Any rallies may give opportunities to sell in the bigger picture, and it's not got a bright outlook at the moment. So fundamentally weak, and it's one of the weaker ones there. S&Ps, well, the S&Ps, I mentioned it earlier, but the asset money has slipped out of that. The trade wars are not helping. They're affecting bigger companies such as Apple, particularly. Any companies that have got big works and are reliant on the Chinese side of things are going to get hit, and that's going to affect one way or the other. As I say, the big money is coming out of that a little bit, or showing that it's coming out. The hedge funds that we kind of reduced their negative positions a little bit, but it's all the same. Just need to watch that. Technically, the S&P is in a bit of a mess. Weekly, it's the weekly picture is still arguably to the upside, but the dailies are really to the downside and choppy. And we've seen a lot of choppy markets. I think, well, maybe as we move into September, with some of these rate decisions coming through, we may see a bit more clarity. But there we are. That's for this week. Technically, if you just want me just to roll quickly through these charts, and I'm going to just take them through on a weekly basis only. Looking at the I said that, now I'm going to have to go to the monthly for the euro, because it's running down, it's making new lows all the way through here, and has the potential to run down back towards that sort of 108 area, which is a sort of next key level as I see it here technically. Now this is all a bit blurred here because of where these this greyed out area is, or blued out area here is, but it's an area of key highs and lows previously, so hence from a shorter time point of view, so that's quite significant in terms of that level being hit. So that's the euro. The pound, you don't need a rocket scientist. Here we go. I'll leave it on monthlies actually. It's certainly been running down. Last month we did actually hold up quite well on the pound. There were some good days on the upside as well. It's some good trades running upside at times, but at the moment we started the month already looking quite bearish there. Dollar yen, when it appears, there we go, we see choppiness. In fact, I will come down the weekly here a little bit more, but the weeklies have been still pushing downwards here, almost a bullish engulfing last week. They didn't quite close up high enough there, but almost may see a bit more movement, but you can see that we've come back to these prior lows. We've gone through where that spike was, etc. It'll be interesting to see. But as I say, I still personally think we'll see maybe some more downside on that at the moment, but we'll see. Aussie dollar weekly, you just see it's running down south. That's don't really, actually the only thing you need to do for that is see where it is relatively, and it's broken the 2016 lows there. It's already broken those earlier on, and broken the 2019 lows there. That he says 18 lows, 19 January lows. So continue to look soft there for the Aussie dollar. And Canadian dollar, choppy. he says, on a basis. In fact, it still looks pretty choppy on this weekly. It's not really giving us weekly, monthly. Weekly wise, it's lower highs still confirmed in there with sort of very spiky type candles here. Got the potential to roll, but of course we've got the news out this week. We need to wait for that. That may give us more guidance for the bigger picture going forward, which is important. And then New Zealand dollar, again another weak one. I'm going to have to come back to the monthly picture just to look at that, and there we go. So we've broken the 2016 now. We're back into the 2015 lows almost, so running right the way back there at the moment. And it doesn't, there's no bright side at the moment I could see for the New Zealand dollar. The only thing that could be helped here is if Trump insists on selling the US dollar and buying the euro and the yen. We may see a knock-on effect through these other markets, but at the moment this looks like it's likely. Yep, we'll get retracements intraday, etc., weeklies maybe, but these do look soft all the same. So that's it. Have a great week, and I'll update you more next week. Bye for now.